Well, good afternoon and welcome to our High Rock Weekly Client Webinar. If you want to skip over any part of this webcast, feel free to use the fast forward control on your screen. Otherwise, sit back and enjoy. Each week on this call, we try to talk about what we see developing in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. I'm Scott Thomason, and joining us on the call today is my partner and colleague, Paul Tepsich, the founder of High Rock. Our certified financial planning professional and wealth forecast specialist, Bianca Thomason, is back, balancing motherhood and our clients' needs. Each week, we record this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this, and all you need to do is visit the home page on our website and click on the Introduction to High Rock Private Client button. We do have a new look to our website. If you want to have a peek, let us know what you think. And as you all know, our priority is to manage risk first and foremost, and currently we believe that we are in a time where investing risk is high and rising. We want to be sure that despite this, our clients have no trouble sleeping at night. So we are doubly aware of the current investing climate and all the many risks that are currently in play. It is extremely important to us that you understand the risk in your portfolio and how we are taking measures to protect you. If you wish to discuss risk in more detail, please do not hesitate to get in touch with us. Well, Paul, volatility has come off its recent spikes on North Korea and the hurricane worries that we had in the previous few weeks. What do you think these days?
Right back down very quickly. As quickly as it goes up, it comes back down even faster and then continues lower. And I can tell you, the VIX is a measure of volatility in the equity index effectively, but they're equity indices, but it's happening in all asset classes. Investment grade bonds are pretty stable. High yield bonds are extremely stable, or when I say stable, I mean low volatility. So it's happening all over the world in all kinds of different asset classes.
And as we look at a longer term picture of volatility, we can see that it is at almost record low levels at this point.
Yep.
We talk each week about how stocks and bonds correlations have been changing and changing to the degree that they're not as dependable as they have been historically. Care to comment on how this is all working out at the moment?
Yeah, this is the U.S. stock bond correlation, and it's behaving like it would normally behave and like we would want it to behave. So I think something important for our listeners and our clients specifically is that, when that white bond yield in the upper part of the graph moves higher, yields go higher, prices go lower, you clearly lose a bit of money on your government of U.S. or Canada bond yields or bond positions. But stocks are also moving higher, so that's part of the diversification and the balancing process. But really what this means is that when that correlation is high, the way it is right now, that if stocks did sell off, those bond yields would go down and the prices up, and that would help, again, continue to help balance the portfolio and provide diversification. So right now it's where we want to see it.
And of course, in Canada, similar situation, although the bonds have certainly been falling in price, rising in yield more rapidly than Canadian stocks, correct?
Yeah, it's been more severe given the Bank of Canada has hiked rates twice within less than 2 months. And the bank doesn't meet again until October 25th, but there was probably a good time to just announce it. There was a deputy governor speaking yesterday, and he effectively said what we've been saying about the Canadian dollar and the tighter monetary conditions index, and the currency weakened off about almost a full cent on the back of his comments. So, and our bond yields seem to have settled down a fair bit in here as well.
Well, you can see that down here in the lower part of this graph, where the Canadian dollar has actually started to weaken up a little bit. And of course, the strength of the Canadian dollar over the last 6 months or so has definitely had an impact on the value of owning U.S. stocks in a Canadian portfolio. The TSX in Canadian dollar, or sorry, the S&P 500 in Canadian dollar terms is only up about 2.25% this year. Now the TSX is basically flat, but maybe slightly higher, but basically flat on the year. And the bond index is down by 2% or more. So it's definitely been taking its toll on Canadian investors. They're not getting the same correlation that they might otherwise get, right?
Yeah, exactly. And I was just spent a weekend with another portfolio manager with a similar business, and he's heavily invested in the U.S. Equity markets. And he was just complaining like he basically just lost his year because of the transfer back into the Canadian dollar, which has improved 10%. So yeah, it's tough everywhere now, given the currency move.
And certainly one of the reasons that we adhere to a more tactical approach to investing, so we're not as dependent on those less reliable correlations, which obviously are not providing the appropriate balance anymore as a result of this, the way markets have gone, and of course the way the currency has moved as well. So what we believe is that this is a better approach to portfolio management, and it does allow us to manage our clients' risk more effectively. In my blog last Friday, I suggested that Canada's economy was going to be vulnerable from three things. One was the Morneau tax plan. Number two was higher interest rates on a heavily indebted Canadian household. And number three was the strength of the Canadian dollar. And today, renowned economist David Rosenberg and a former colleague of yours, Paul, joined me in those concerns. Any comments?
I didn't watch that piece, but certainly reading it, there are a lot of I think there's another story in the press as well about some of the negativity in the Canadian market right now between these tax changes, currency appreciating 10% in 4 months, our stock market sitting flat on the year, the only G20 nation that is flat on the year, or not up pretty big on the year, in fact. And you could say there is and interest rates having gone up in our housing market, still trying to find a base in certain types of housing and certain geographies. So, all those things combine that could be difficult moving forward. And I think the bank will pause on its rate hikes, and that will drive the Canadian dollar to a weaker point. But let's hope it's not any worse than that. And actually, maybe a good time just to say to our listeners that there are still some bright spots in the Canadian economy, and certainly in our portfolio that is more Canadian specific. So it's not all doom and gloom. There are pockets of growth and investment potential.
And talking on the point of the new tax proposals, just for our clients, we are keeping a very close watch on how these changes may impact you, and we will be happy to dialogue with you on what we think would be the most appropriate strategy to follow. Now, we are not accountants. However, we strongly recommend that you include your accounting professional in any discussions with us on your investment strategy as we move forward. But as I said, we're going to be up to speed following all these proposed tax changes. And of course, we want to make sure that we're looking after our clients' best interests all the way through.
Well, you could probably add too, Scott, that you and I own High Rock Capital, and it's a small business, and we care about these changes on a personal level and on a corporate level as well. It matters to us as much as some of our clients. So I just mentioned too, I was at our local MP hosted a town hall on this issue last Tuesday. I was invited to, and I went, and it was a complete food fight. It was unbelievable, something to behold. So I think there is an uprising going on, but we'll see. But if anyone has any questions or wants to know what our views are at the current state, they should contact us directly.
And of course, we remind you all that historical returns are no guarantee of future returns. But as you know, at High Rock, we do work very hard to provide our clients with the best possible risk-adjusted returns. And we also remind all of our clients that we are diligently working toward achieving your specific long-term goals as set out in your wealth forecasts. Now, these goals are intended to be achieved over longer time horizons than those that we might achieve in one single year. If you wish to review your wealth forecast and any part of your strategy, you are always available to do so. Just let us know. I know that now that Bianca is back in a greater capacity, we'll be setting up a lot of reviews with clients. So if we don't hear from you, you'll certainly be hearing from us in the very short term. Key themes for 2017, you all know them, but I'll go through them. We want to avoid risk when risk is high, and we think that at the moment risk is very high, and that means being more tactical inside an investment portfolio. The level of inflation or expected inflation is a key determinant for central bank policy, as is the liquidity that is in the system due to the recent years of extraordinary monetary policy. Rising borrowing costs and reduced financial system liquidity may increase volatility going forward. Volatility, as we said, is at very low levels. Stock prices and valuations are close to their highs, but without more significant earnings growth, this leaves them vulnerable to correction. And the Trump agenda has had little success so far in adding to U.S. economic growth, as had been hoped. Brexit negotiations and NAFTA renegotiation tensions with North Korea, Russia, and the Middle East, as well as global cyber attacks and terrorist threats, all add to the blend of political uncertainty that confront us on an ongoing basis. Well, we talk about it each week, but the evolving inflation story, one of our important themes, has been perplexing as we try to assess the implications for central bank monetary policy and interest rates. If economies are growing, inflation should be growing, but this does not necessarily appear to be the case at the moment. And all central banks have a mandate to maintain price stability. Interest rates and monetary policy are used to keep inflation at targets in or about 2%, the 2% level. Currently, only the Bank of England is dealing with inflation above that level, but they are also dealing with Brexit and an economy that has stalled. The US Fed and the Bank of Japan will announce their latest decision on interest rates tomorrow. But interest rates are no longer the major focal point. The hows and whens of central bank balance sheet reduction are now the main topic. And Paul, we've talked about this a number of times in the past, and it's been the extra liquidity in the system that motivated stock markets initially. As the excess liquidity is removed from the system, this should have the reverse impact, correct?
Well, it should, yeah. And what this chart shows us to explain it is in this order. The white line and shaded blue is the Fed's balance sheet, which before the credit crisis in '08 was at 800 billion and is now at, as you can see, 4.5 trillion in white. And the green line is the S&P 500 index, and the purple line I added in was the U.S. stock market margin debt. So people borrowing money to invest in the stock market. And actually, Scott, we probably should have made that chart longer on the margin debt, because I think margin debt is, without looking it up on Bloomberg and typing in the keys, it's at an all-time high, as is the stock market at an all-time high. But it's worse than other sort of peaks in the market, like in 99, 2000, and in 07, 08. So that's something to watch too. We haven't looked at margin debt in a while, but clearly it's moving upwards with the market at pretty tight correlation.
Yeah, maybe we'll extend that chart next week. We'll show it again and extend it.
Yeah, let's make a note of that.
Sure. And now today you wrote a blog, and I just thought maybe, in anticipation of the Fed meeting tomorrow, or the announcement tomorrow, you might want to talk about what's happened in the past with quantitative easing and how it's impacted the markets and interest rates. And I thought maybe you'd like to go through that quickly.
Sure. It's a really busy chart, and I'll keep it brief. But QE is quantitative easing, and effectively, what quantitative easing is when the Fed, or now a lot of central banks around the globe, went out and bought bonds, different types of bonds in the open market. So they bought government bonds. The U.S. started with government bonds, and they started buying mortgage bonds, and the ECB and the European Central Bank ended up even buying investment grade bonds. So very unconventional form of monetary easing. So basically, just starting at the left, you can see when QE1 started in December '08, the white line is 10-year treasuries and in yield. And you can see how, well, you would have thought, well, if the Fed starts buying U.S. treasuries, well, yield should go down. But in fact, it went up. When they ended QE1, rates went down. QE2, same pattern. QE3, same pattern. And now they've been talking about reducing the size of their balance sheet on the far right in the orange arrow. And lo and behold, for the past, year to date anyway, rates have actually largely been going down. So, there are a couple of conclusions here, but if the history repeats the same pattern, this is where we're likely to see rates continue moving down as the Fed unwinds its balance sheet. Now, the only thing about the stock market, I think, Scott, is that if rates continue to move down, that's somewhat supportive for the stock market. And that, I think, largely has been what's driving the stock market higher, is that rates have stayed largely lower for longer than most market participants would have thought.
And that brings up even further interesting discussion, because we're starting to see third quarter economic data that has certainly put expectations at a somewhat lower third quarter GDP forecast at 2.2% right now. But analysts have also cautioned that the impacts of the hurricanes Harvey and Irma could actually reduce that number by almost a full percentage point lower. So we're starting to see some impacts. Certainly there'll be temporary impacts, but they're still impacting U.S. economic growth. And at the same time, as we've talked about, the yield curve, the spread between the 2-year and 30-year bonds is narrowing, and it's narrowing to a point where it's about 141 basis points. But the trend from the upper left, from above 200 basis points now at 141, when that moves towards zero, that is signaling the potential for a recession to come. In Canada, similar circumstances. We've got the Bank of Canada raising rates, pushing short-term rates higher, but in fact, the gap between short-term rates and 30-year rates, the 2-year yield to 30-year spread, is now at about 88 basis points. So again, when that gets closer to zero, there's your potential for recession. So there's some things that we have to be particularly cautious about when we see longer-term bond yields falling while shorter-term bond yields are rising. Correct?
Hey, Scott, I would just add too that you said it in the past, maybe not for a while. Pretty much every recession in North America starts with the central banks hiking policy, hiking interest rates prematurely and for too long, too much and too long. They basically cause pretty much every recession, whether they're trying to eliminate a bubble like in the dot-com bubble in 00, or the housing bubble in the US in 07, or maybe today what one could argue was a housing bubble in Canada. And that's why the bank is raising rates. Either way, kind of irrelevant, whatever the reason is, they all start with central bank hiking rates, and that's the period we're in right now.
Well, and that's going to be something that is going to be significant, because we've got higher costs of borrowing, and again, as we mention each week, global debt at record high levels. And just last Friday, the national accounts for Canada were posted. Even though second quarter GDP was strong in Canada, household debt levels increased while household income grew at a slower pace, pushing up the proportion of debt relative to income. There was $1.68 in credit market debt for every dollar of household disposable income. And debt also grew at a faster pace than did the value of total household assets. And I think that comes into play a little bit with what you just said, is that we've got asset prices in Canada generally declining or holding steady while debt continues to grow. And I think you'll look back, and if you look at 2008, 2009, there was a serious decline in asset values that pushed that leverage that we see there significantly higher. And obviously, if asset values fall in Canada while debt is continuing to increase, that could create the same circumstances, right?
Absolutely.
All right. Well, I'm not going to go through it in too much detail. Again, earnings are expected to grow, but at a significantly slower pace than we've allowed stock prices to go higher. And we talk about this every week, but we believe that by virtue of earnings, stocks certainly are expensive. Turning to the geopolitical front, of course, we keep an eye on the Trump agenda week to week. Senate Republicans are making one last-ditch effort to repeal Obamacare and have the daunting task of assembling 50 votes for an emotionally charged bill with the limited details on how it would work, what it would cost, and how it would affect health coverage. All this has to be done in 12 days. They need to act by September 30th to use a fast-track procedure that prevents Democrats from blocking it. So they've got their work cut out for them. And of course, today, President Donald Trump told world leaders in his first address to the United Nations that they must confront a handful of rogue regimes. And he singled out North Korea and vowed that if the dispute over its nuclear program leads to war, the country, North Korea that is, would be destroyed. He said no nation on earth has an interest in seeing this band of criminals arm itself with nuclear weapons and missiles. Trump called the North Korea regime depraved. In any event, we will undoubtedly get some kind of response in one way or shape or form or another from the North Koreans. And Paul, what do you think? More missile tests?
I think so. I think North Korea is trying to bait the U.S. and the UN into acting in first strike, and that may happen. I don't know. Otherwise, it seems to be an idle threat. You spend $700 billion a year on your conventional military. I think Iran's probably laughing at them right now. But I really, I've got some views on it. But I think at this stage, for us, all we can do is try and protect our portfolios a little bit with certain measures, which we feel like we've taken. I can go through them. Basically, our clients would know that we bought U.S. dollars sold Canada about 6 weeks ago and just above this level. That should be protective if there is a war. We own a decent amount of government bonds, which should be provide a flight to quality, the same as U.S. dollar. And we own a pretty good chunk of cash. So we are still invested, and we've got some opportunities in here. One of them played out pretty well on Friday morning, or Friday, being Yellow Media. They announced a new CEO, and the stock was up about 15% on Friday alone. Now it's naturally going to sell off a little bit more from that level, but there are opportunities within the portfolio like that. So we're trying to balance a really cataclysmic event like war with our tactical approach to continuing to invest in what we see as good, strong risk-adjusted returns.
And at the same time, we are underweight in our global equity exposure, which really hasn't hurt our portfolios to any great degree because the Canadian dollar, because of its strength, it's pretty much negated any potential upside that we might have otherwise had. So it hasn't been to our disadvantage to be underweight global equities at this juncture, and at the same time allows us to continue to be err to the side of being a bit more defensive.
Oh, look at that. Am I looking at Miranda Thomason?
I would say so.
She was just one of our two High Rock sponsored athletes, and she was just crowned the Ontario Provincial Triathlon or Triathlete champion for 2017 season. That's fabulous. Good news. Good for her.
Very exciting
nice
stuff.
Outfit too.
Very exciting stuff in our family.
Oh, for us, for everybody.
All right, and let's go to our listeners at the moment. See if there's any questions that they have that they want to bring forward.
Okay, I have a question. That there was an article in the Financial Post recently that the headline was Canada flagged as hidden 14 trillion credit bubble stokes global crisis fears. Can you basically sum up in a nutshell what that was all about?
Yeah, I can. First of all, I think this article, I don't know who the journalist was. I did read it. But I would say the journalist, it's a very disjointed article.
That's why I was having trouble following it.
Yeah, well, and you should, because it is disjointed. Oh, yeah, there's the journalist. But it effectively, the BIS is the Bank for International Settlements. So that's the global banking regulator. They set a lot of policy and they do a lot of this type of work. But this article, and the headline to that article, Canada flagged as hidden $14 trillion credit bubble stokes global crisis fears. That's not 14 trillion in Canada. But what this effectively, I think what the author at the BIS is trying to show is that there is an enormous amount of off-balance sheet debt and leverage in the global banking system. And we're talking about commercial money center banks, not central banks. And really what those are called credit derivatives. And credit derivatives, again, they're off balance sheet. It's not like a bank is making a loan to a corporation. Credit derivatives are a huge market. They're traded over the counter, not on an exchange. And so they're somewhat opaque. And that's part of what led to the crisis. And if anyone read the book or saw the movie The Big Short, the guys who made all the money.
Yeah, that's what I was thinking this was kind of like.
Right. And that was a lot of people, including where I used to work at Merrill Lynch, lined up on the same side of the boat, clipping out effectively a coupon or a carry or interest from selling protection. And the hedge fund guys you saw in the movie were basically buying that protection, and they ended up doing well. But I digress. The credit default, it's hard to say. That article doesn't give you any detail. So you don't know what's behind those credit default swaps. If there are 14 trillion outstanding, I think it's more like 10 trillion US outstanding, they could be across several different types of derivatives. There are FX or foreign currency swaps. There are credit default swaps. There's credit default swaps of credit default swaps. There are credit default swaps on commercial mortgages right now, CMBS. And in fact, the CMBS market is starting to get hit in the US with the closures of a lot of shopping malls. And Toys R Us just filed for Chapter 11 and CCAA in Canada, creditor protection. So the bottom line is that there are a ton of these credit derivatives in the market, foreign currency derivatives, and who knows what a bank like JP Morgan has on the other side. Like, they could be net flat risk, They could be completely loaded up on the other side of the boat on risk. I do not think that they are all loaded up on the same side of the boat. These banks are now way better regulated than they were pre-2007. They're highly regulated by the Federal Reserve Bank of New York. Could they pull a fast one over on the regulator? For sure, but I don't think it's like it was in '07.
Okay.
So I'm sure there's more to the actual research piece than is in the Financial Post, but I've not read the research piece. But this article is kind of all over the place, and it kind of has shock value. But I really
I just wondered, like, so what, right?
Well,
like I think you've just answered that when you said the banks are highly regulated, because you are shocked when you first read that, and but
like if it was that serious an issue,
mm-hmm.
then the BIS, the Bank for International Settlements, would force these banks to fall in line. They'd put regulations on them as to what kind of derivatives they can hold.
Right. Okay. Thank you.
Great questions, and certainly we enjoy getting questions. And if we don't hear from you live, please feel free always to email us with questions, and certainly any feedback that you'd like to send in. We certainly want to talk about things on these calls that our listeners want to hear. But we thank you all for taking the time out of your busy schedules to tune in. We'll be back with our next update next Tuesday. Until then, this is Scott Thomason, and on behalf of my colleagues Paul and Bianca, we want to wish you all a great rest of the week and a wonderful weekend coming.